The Morgan Report with David Morgan.
David Morgan with you, the morganreport.com. It is 19 February 2021. Well, I could probably talk all day on what's going on in the silver market, but I will try to keep this down to 10, 15 minutes. I'm going to start off here on the Wall Street Silver website, and this has been posted there. The article's titled, "Could Silver Do a Palladium?" by David Smith. David's been one of the team from almost the very beginning, a great must-read, kids. And he talks about a little bit, and this is the article itself. And David and I had a bit of a chat before I wrote the article, and I don't try to control much. But he did ask me about my Palladium position that I had years ago and what happened. Short read, it's on SilverSeek, it's on SGT Report, it's all over. And basically the essence is, what the ratio has been. And Palladium basically took off due to physical demand, and it kind of crushed the paper situation for a while. The LME at the time, to best of my memory, what actually stored most of it, actually allocated it out as far as who got to lease it. And I don't even remember what interest rate or not. I won't go that far. It's very interesting to see what took place back then, and David's alluding to that in this article. So, yes, it's a bit of self-promotion, but it seems to be one of these that's kind of going viral. Suggest you take a look at it. And another look, this came out today, and this is from CPM Group. There's really two houses that do, there's several, but there are two main ones that do research and put out like yearbooks or reports annually on the metals. And Jeff Christian, general manager of CPM Group, has been doing it for years. I've known Jeff for years. They do it. They do it in silver, gold. They do it in the PGMs. They do it in copper and a few others. And I think their numbers are pretty spot on. The reason I can say that is I get to look at them versus what the Silver Institute puts out. They usually jive pretty closely. No one knows to the exact ounce how much is recycled, for example. A pretty good handle on what the miners are doing because they have to report if they're public companies. So anyway, this just came out today, and it talks about silver's short-term and long-term look. And this is kind of rather bullish, not as bullish as I am, but we all have our opinion on where silver is now and where it's going. Says why CPM believes silver prices will rise in the short term. It does not forecast gains in prices to be unprecedented or record levels at this time. That may come later, in a few years. Any sharp gains in price at this time are likely to be short-lived. Prices may rise well above 30, but they also may not stay that high, as has been the experience in the past 6 months. Longer term, CPM expects silver prices to rise to record levels at some point in the next 3 to 10 years. I would pretty much go along with that. I'm not going to be, first of all, no one really knows. Secondly, my forecast is the next 3 years. As anyone that's followed my work very closely or listened to what I've been doing for many years, and usually on these updates, both public and for the members only, the premium service, the biggest part of the move comes in the last part of the time. We're pretty long in this cycle in the silver market. I think it's more likely to happen over the next 3 years than the next 10, but I don't know. It could take longer. It's interesting. I don't remember Jeff saying longer term expects to rise to record levels, and I don't want to read too much into that. What does that mean? Does it mean above 50? To me, it does. A record would be a new record, which would mean above 50, but is that what he means? Sometimes we talk to each other, we hear each other, and I know what you said, but I don't know what you meant. So I'll leave it at that, trying to be fair and balanced in this breakdown of this article. And here's the part that is going to be controversial. I'm trying to show both sides. He talks about some of the chatter out there on the web about the current move, and it's based on investor optimism and less on any sharp increase in fabrication demand or sharp decline in supply. Well, supply is the supply. That's been pretty steady. We've kind of topped out, depending, again, which study you use, CPMs or the Silver Institutes, but you're roughly round numbers 800 million, and you get to $1 billion a year if you factor in, which is you need to, the amount recycled. And there's no agreement exactly on how much is recycled, but you're looking at like 170 million ounces, maybe up to 200 million. So the total supply, recycled silver and mine supply, comes in at about 1 billion. Mine supply, only round number again, 800 million. So it's been level. It's actually been dropping off a couple percent a year over the last 3 or 4. I'm going by memory, but it has. So here's what's interesting on this paragraph here. Part of this trend is nonsensical conversations, how there is no silver to meet ETF and investor demand. That is not the case. And the commentary to this point displays a total lack of understanding of silver inventories and silver market mechanics, as well as what happened in early February when the Wall Street Bets boys tried to squeeze the silver market. So I want to break that down, and I'm going to leave this last part out about as well as what happened in February and the squeeze from the Wall Street Bets on the GameStop, and just look at the part I highlighted here. So part of the trend, this conversation makes no sense. Understanding it's not the case. Commentary points to total lack of knowledge of silver inventories and silver market mechanics. And I'm going to put a period there because let's just look at that part of it. I'd like to break it down and see, what's up. So question in my mind is what data we do have. Is it contradictory to that statement or is it not? You can decide for yourself. Now remember, what I just showed you just came out on the 19th. This is from the 16th by Ronan Manley, who I will shout out to him. He's doing some great stuff here. And so he talks about what happened a few days ago. Remember, this was written on the 16th, following the silver squeeze SLV trading from the 29th of January through the 2nd on the New York Stock Exchange ARCA. The very same SLV had quietly and without fanfare amended its prospectus. The demand for silver may temporarily exceed supply. Now, that's pretty darn obvious. I mean, this is a quote directly from the change in the prospectus of the largest ETF in silver, the SLV, that is on the New York Stock Exchange. So, going further, they may temporarily exceed the available supply. That is acceptable for delivery to the trust, which may adversely affect an investment in the shares. To the extent that demand for silver exceeds the available supply, at the time, authorized participants may not be able to readily acquire sufficient amounts of silver necessary for the creation of a basket. It is possible that authorized participants may be unable to acquire sufficient silver that is acceptable for delivery to the trust for the issuance of new baskets due to a limited then available supply with a surge in demand for the shares. In such circumstances, the trust may suspend or restrict the issuance of baskets. So I'll leave that where it is. This is a quote. This isn't opinion. This isn't, anything else. It's directly from what the SLV put in writing. And then Ronan goes on to talk about the SIVR, which is the second largest ETF in silver, to my knowledge. And the prospectus for the SIVR says, and it's quoted, as of the date of the prospectus, the fund and other silver ETPs, which is exchange-traded products, which are primarily ETFs, are experiencing a sudden increase in demand of shares falling in an online campaign to harm hedge funds and large banks with substantial short exposure to silver. That's a quote. So you can measure that against the other statement and make your own determination. Further, it goes on to say the campaign encourages retail investors to purchase shares of ETPs as well as physical silver in order to intentionally create a short squeeze. Now, I thought in a free market you could buy what you wanted, and if there was a large demand for wheat or oats or corn, the price would go up. If there was a large demand for housing in the Reno area and there were so many people wanting to buy, they had a lottery so that those that won the lottery were allowed to purchase a home in that neighborhood. I mean, this is basic economics, Yeah, if there's a huge demand in something, and yes, there are short squeezes. What isn't talked about here in this from Ronan's article is how many times some of the, let's say, banking establishments have run the stops on the public or on the trading funds. And running the stops is basically a way, it's often done with spoofing, that takes the price down and wreaks havoc with the silver market time and time and time again, and puts money in the pockets of the other side. In other words, the shorts. Whether they're hedged or not, running the stops is a term that you will hear quite often if you trade futures, which I've done for years and years and years. So it's okay to run the stops, but those people that want to buy, futures or ETPs or ETFs or physical silver, they are the bad guys. The way I interpret this. Now, you are free to see it differently. That's what makes a lively discussion. So finishing this paragraph, it's by fiscal consideration to intentionally create a short squeeze. This activity could result in temporarily inflated prices. So that kind of goes with what CPM's saying. He doesn't expect this thing to last long. So, I think they match. And the difference between trading price and net asset value share may widen. So whenever you get a wide spread, it's usually because you have a volatile market and there's a mismatch between the paper and the physical. And this, of course, is what happened in the Palladium market, which is what I talked about at the beginning of this weekly perspective. So I will finish off, I guess, with what Ronan wrote here. So there you have it. One of the biggest backed silver ETFs in the world, apart from the SLV, with a claim to 36.7 million ounces of silver stored in London with the custodian, JP Morgan, is not worried about the interests of its investors, but the outstanding short interest silver positions of the hedge funds and large banks. And out of concern for these entities that are short, Aberdeen Standard is fearful of market forces, which will intentionally increase silver prices. So I think most that buy an ETF or an ETP that's associated with silver or silver prices are long silver. They expect the price to go up. You don't usually buy a stock if you think it should go down, unless you're short the stock, obviously. So it's rather disconcerting to me, and again, you can make up your own mind, but I said I'd stop there, but I think I should continue. So those with a sharp eye may also ponder why Aberdeen Standard is worried about a divergence between the trading price of the SIVR and its net asset value. And why would that be? Maybe it's because of the date 3 February is the last time the SIVR added any new silver holdings, a date on which its claimed silver holdings rose from 35.6 to 36.6 million ounces, obviously 1 million ounces, but no increase in silver holdings since then. Now, that may have changed. Again, this came out, I think, on Tuesday. This is Friday afternoon, a few hours before market close in the silver market. Also, that none of the claimed SIVR shares is held in the vault of the infamous custodian JP Morgan in London, but all of the claimed silver is said to be held in the vaults of 3 SIVR sub-custodians, namely Brinks, Malcolm, and Loomis. So it's interesting. So he concludes with this, and I will conclude with this. So maybe after the SIVR panic of 2 February is not so different from that of the iShares Silver Trust SLV on 3 February, which is a reminder and to come back full circle, warned in its prospectus change that the demand for silver may temporarily exceed available supply that is acceptable for delivery. So let's leave it there. There's probably more in common here than maybe I am indicating, but I'm just trying to read both sides of the story here, and the officialdom is talking about a temporary, and usually a squeeze is a temporary event. I'm not saying it isn't, I'm very bullish long term. I do think we'll get above 30. Will we stay there or not remains to be determined. My take is at this point, and what I've seen talking to PAMF, Harris, hedge funds that actually trade in the physical, some that trade in the ETFs, everything I've been able to determine is there's a lot of pressure to the upside of the silver market. And as far as I'm personally concerned, the price around the 27 level or so is not reflecting the true dynamics of the physical and the paper markets at this time. So I will leave it at that. This is David Morgan of themorganreport.com. And shameless plug, if you're not involved with our free information, please go to the website, themorganreport.com, and sign up for a free newsletter. It's on the front page, and there's lots of information there on the blog and other pull-down menus. So great weekend all. A couple things to look at, ponder, think about, and I will be back. Remember, all I really want to get to is a fundamental change in the money system, and that's been my big idea for a very long time. Silver is really a subset of that. We need truth, fairness, and honesty throughout the monetary and financial systems. And as far as I can tell from the time I was a teenager until present, that has not been achieved. In fact, the financialization and the rule of the money masters has only increased as far as I can personally determine from all I've been doing for the last 4 decades. So leave it there. I'll be back next week with you all.